Did you know that in the current market, the average down payment for a home can be over $40,000? That's a huge chunk of change many simply can't afford right now. Today, we're going to show you how renting in 2026 can actually be a smarter financial move than buying, and how to make it work for you. If you're finding this breakdown helpful, consider subscribing for more insights into navigating today's economy. Let us know in the comments, what's holding you back from buying a home? For decades, the mantra has been, renting is throwing money away. It's a deeply ingrained belief. But in March 2026, with home prices stubbornly high and interest rates fluctuating, that old advice might be costing you. Let's look at why. The initial costs of buying, that hefty down payment, closing fees, moving expenses, can easily run into tens of thousands of dollars. Renting, on the other hand, typically requires a security deposit and first month's rent, significantly lowering that upfront barrier. This immediate financial breathing room is invaluable. The notion that renting is simply throwing money away is a deeply ingrained sentiment. However, in today's economic landscape, with persistently high home prices and fluctuating interest rates, renting can actually be a remarkably strategic financial decision. Consider this. The median home price in the U.S. reached over $400,000 in early 2024, according to the National Association of Realtors. One of the most immediate and tangible advantages of renting lies in its significantly lower upfront costs compared to purchasing a home. While buying often requires a substantial down payment, closing costs, and immediate repair funds, expenses that can easily tally tens of thousands of dollars, renting typically only demands a security deposit and the first month's rent. This stark difference in initial outlay frees up considerable capital. Furthermore, renting offers invaluable flexibility. In a dynamic job market, or for individuals who prefer not to be tied down geographically, the ability to relocate with relative ease is a significant benefit. Is it always practical to be locked into a fixed location when career opportunities or personal circumstances might change rapidly? This adaptability is a powerful, often undervalued asset. Many people believe renting is akin to simply discarding funds. However, in today's economic landscape, where home prices remain elevated and interest rates fluctuate, renting can actually be a remarkably astute financial decision. It offers significant flexibility and requires considerably lower upfront capital compared to purchasing a property. But to truly maximize this advantage, a proactive approach to the rental agreement is essential. Consider the lease not as a rigid contract, but as a starting point for negotiation. Landlords are often motivated to secure reliable tenants, and this can be leveraged. For instance, offering to extend the lease term by an extra 6 months might prompt a reduction in monthly rent. Data from the National Multifamily Housing Council indicates that concessions, such as a free month's rent or reduced security deposits, are more common than many realize, especially in competitive markets. What if a fresh coat of paint, updated fixtures, or even a pet-friendly policy could be secured as part of the deal? These seemingly small perks can significantly enhance the living experience and add tangible value. Furthermore, understanding market trends is key. Researching comparable properties in the area and noting their advertised rates can provide powerful leverage. If similar units are listed for less, it's a logical basis for requesting a rent adjustment. Why wouldn't a landlord consider a slight reduction to secure a qualified tenant quickly rather than risk vacancy? Many often feel that rent payments are simply money lost, a recurring expense with no tangible return. However, in the current economic landscape of March 2026, this perspective warrants a closer look. With persistently high home prices and fluctuating interest rates, renting can actually be a strategically astute financial decision, offering significant advantages in flexibility and immediate cost savings. Consider this. The average down payment for a home can range from 3.5% to 20% of the purchase price. For a median home price of $420,000, that's a difference of over $14,000 to $84,000 up front, according to data from the National Association of Realtors in late 2023. This substantial capital freed up by choosing to rent can be strategically deployed elsewhere. Beyond the conventional apartment listing sites, a world of more affordable housing options exists. Exploring local community boards, social media groups dedicated to housing in specific neighborhoods, or even reaching out directly to property management companies for unlisted units can uncover hidden gems. These less conventional avenues often bypass competitive online markets, leading to better deals. Furthermore, understanding alternative living arrangements such as co-living spaces can dramatically reduce monthly housing expenses. These models, where individuals share a larger property and its amenities, can offer savings of 10 to 20% compared to renting a solo apartment, as reported by industry analysts. This allows for a lower cost of living while still accessing desirable locations. There's a common sentiment that renting is akin to throwing money away, a notion deeply ingrained in many financial discussions. However, in the current economic landscape of March 2026, with persistently high home prices and fluctuating interest rates, renting can present a remarkably strategic financial advantage. Consider the substantial capital that remains uncommitted when opting to rent. A typical down payment alone can range from 3.5% to 20% of a home's purchase price, meaning for a $400,000 home, that's anywhere from $14,000 to $80,000 in upfront cash that doesn't need to be tied up. Beyond the down payment, the costs associated with buying a home are significant. Closing costs, often between 2% and 5% of the loan amount, can add thousands more. For that same $400,000 home, this could mean an additional $8,000 to $20,000. Then there are ongoing expenses like property taxes, which vary widely by location but can easily add hundreds of dollars per month, and the unpredictable costs of maintenance and repairs. A study by Home Advisor in 2023 estimated that homeowners spend an average of $1,000 to $1,500 annually on maintenance. When these substantial upfront and ongoing expenses are avoided by renting, the financial liberation is considerable. This difference isn't just money saved, it's capital that can be strategically deployed to build wealth. Think of it as having an immediate investment fund ready to work. The significant savings realized from choosing to rent over buying present a powerful opportunity for wealth accumulation. Consider the substantial difference in upfront expenses alone. While a down payment for a home can easily range from 5% to 20% of the purchase price, and closing costs can add another 2% to 5%, renting typically requires only a security deposit and first/last month's rent. This freed-up capital can be strategically deployed. One effective approach involves high-yield savings accounts, HYSAs. As of early 2024, some HYSAs were offering annual percentage yields, APYs, around 4.5% to 5.5%, according to data from financial comparison sites. This provides a safe, liquid place to grow emergency funds and short-term savings. For longer-term goals, investing in a diversified portfolio through a brokerage account is a logical next step. Index funds and exchange-traded funds, ETFs, offer broad market exposure with historically strong returns, often outperforming inflation over time. The average annual return of the S&P 500 index, for instance, has been approximately 10% over the past several decades, as reported by financial data providers. Furthermore, maximizing employer-sponsored retirement plans, such as a 401k, is crucial. Contributions to these plans often come with employer matching, essentially free money. Automating contributions ensures consistent saving, and the power of compounding growth over years or even decades can dramatically increase the final value of these investments. For a long time, the prevailing wisdom suggested renting was simply throwing money away. But in today's economic landscape, with home prices remaining stubbornly high and interest rates fluctuating, renting can actually be a remarkably strategic financial decision. Consider this: the median home price in the U.S. hovered around $417,000 in early 2024, a figure that can feel out of reach for many. What if consistent, on-time rent payments, often viewed as just an expense, could actively contribute to building a stronger financial foundation? This is precisely the opportunity presented by rent reporting services. These platforms allow landlords to report a tenant's payment history to the major credit bureaus, Equifax, Experian, and TransUnion. Did you know that a significant portion of an individual's credit score, around 35%, is based on payment history? By having rent payments included, individuals can demonstrate a consistent ability to meet financial obligations, much like a mortgage payment would. This can be particularly impactful for those new to credit or who have limited credit experience. For instance, according to Experian data, individuals who use rent reporting services have seen their credit scores increase by an average of 13 points. This consistent positive reporting can be a powerful, yet often overlooked tool in a financial toolkit. For many, the idea of renting conjures images of throwing money away, a notion deeply ingrained in financial thinking. However, as March 2026 approaches, with persistently high home prices and fluctuating interest rates, a different perspective emerges. Renting, strategically approached, can be a powerful engine for future financial success, offering a level of flexibility that traditional home ownership often lacks in uncertain times. Consider this: the median home price in the U.S. has seen significant increases, making the upfront costs of buying, including down payments and closing fees, a substantial barrier. A report from the National Association of Realtors in late 2023 indicated that median home prices had risen considerably year over year. This reality often means that the initial capital required for a down payment alone could exceed $50,000 for a modest home in many markets. Wouldn't that capital be better utilized elsewhere, building wealth instead of being tied up in an illiquid asset? Furthermore, the true cost of ownership extends far beyond the mortgage. Property taxes, insurance, maintenance, and repairs can add a significant percentage to monthly housing expenses. For instance, annual property taxes can easily amount to 1 to 2% of a home's value, a recurring cost that renting typically avoids. This is where the renting advantage begins to take shape, creating a tangible difference in monthly cash flow.